We did not find evidence of widespread misconduct within New Zealand's banks. However, there is much to do to create an environment where we can be confident that that will not happen. We have also laid out some thinking about the overall regulatory framework for retail financial services in New Zealand and some areas that we believe require attention. This is the first time that New Zealand's two financial regulators have worked so comprehensively and collaboratively together, and I'd like to commend the teams from both organisations that have worked so hard to get this report complete in the timeframes we set back in May.
Sorry, can we ask the reporters to mute your phones so we don't hear them through the speakers?
Yeah. So for those dialed in, would it be possible to mute your phones, please, so that it doesn't provide feedback for the guys in the room? Thank you.
They won't be able to hear us.
Okay. So both Adrian and I believe that the behaviour of New Zealand's major financial services providers and the way they treat their customers is critical to the economic growth and societal well-being of the country. So I'm going to quickly run through a summary of the findings and then take you through those findings in a little more depth and then hand to Adrian. So in summary, as I've said, misconduct and poor culture issues do not appear to be widespread at this point. We found only a small number of issues related to poor conduct by bank staff. We identified more than 50 remediation activities in progress or recently completed as a result of system, process and staff issues that impact an estimated 431,000 customers and cost an estimated $23.9 million to remediate. But there is much work still to do. The review found significant variation in the maturity of banks' approaches to assessing or managing conduct risks. Some banks appear reactive at best to these issues and complacent at worst. Most banks are at an early stage of embedding the necessary focus on long-term customer outcomes. And what we mean when we talk about customer outcomes are customers receiving products and services that they understand and that they benefit from and can bear the risk and cost of on an ongoing basis. So let me delve into the themes behind the key findings in a little more detail. And we broke these into 4 buckets. First, delivering good customer outcomes. Secondly, governance around culture and conduct. Third, risk management around conduct. Then fourth, the identification and remediation of conduct risks. So first, delivering good customer outcomes. In our view, banks currently do little to monitor long-term customer outcomes as opposed to short-term customer satisfaction, often measured at the point of sale, where by the very nature of that interaction, customers tend to be comfortable with the decision that they've made and are in no position to judge the longer-term benefits. The risks of poor customer outcomes are increased by incentives offered to, or targets imposed on, sales staff, which are typically focused on volume-based or value-based metrics and insufficiently on customer benefit. Secondly, conduct risk governance. We find that all banks need to improve their governance processes around culture and around conduct risk. The reporting we saw to boards and management on conduct risks is weak and at an early stage of maturity in most banks, especially the smaller ones. Risk management. There is variability in the quality of conduct risk management, and some banks have significant work to do in this space. Only 6 of the 11 banks reviewed had analysed their conduct risk against the FMA's conduct guide. In some cases, banks have only taken that sort of action as a result of this review. This lack of action is surprising, to say the least. Not enough has been done to hunt down risks within products or practices where there may not have been complaints or regulatory pressure, but nonetheless, there is a risk that customers are not being served well. Lastly, issues identification and remediation. The majority of the issues identified that were being remediated appear to have been caused by systems or process weaknesses rather than poor conduct. But we found relatively few banks making determined efforts to find issues caused by poor conduct or poor conduct risk controls. The systems and processes for recording complaints were inconsistent and poorly constructed. Across the industry, procedures for staff to raise issues were not effective and rarely used. While some banks have worked on their whistleblowing processes, we found that generally staff do not trust the confidentiality or anonymity of those processes. The response to complaints and inquiries where they do happen is mostly reactive, and there seems to be little attempt to draw broader conclusions about where customers are being let down or where their expectations seem misaligned with those of the bank selling them the product. So having run through the key findings of the report, I'll hand to Adrian to talk about some of the recommendations that we've included for the banks.
Thank you, Rob. And I'd just like to start by thanking all of the staff of both the RBNZ and also the FMA for a significant effort to get this report here for us today in such a short period of time. And it is a serious piece of work that I know the banks need to take seriously. In terms of recommendations, there's a range of areas where banks need to be more effective, and that's in both identifying, managing, remediating and reporting on conduct risk. The 5 key areas should come as no surprise. The first area obviously is around ownership by the board and senior management themselves. Board ownership and accountability is critical for the better measurement and reporting on conduct and culture risks. The second area is around prioritising the identification and accelerating the remediation of issues. We found that both the identification and certainly the pace at which issues were remediated is well short of satisfactory. To do this, obviously, they need to have significant strengthening of the processes and controls that prevent or detect and manage these conduct and culture issues. Again, very little forward-looking frameworks for it, instead generally reactive and quite isolated at times. Strengthening staff reporting channels is very important. As Rob mentioned, the whistleblowing process is little used and sometimes little trusted. So no whistleblowing doesn't necessarily mean no issues. That has to be improved. And revising the bank incentive structures. And I imagine this will be one of the most difficult issues for the banks. And it's one where the FMA are going to be coming out in mid-November with some suggestions around the incentive structures that operate within the banks. But we expect banks to revise and implement changes to their incentive programs, and any that don't commit to removing these volume or value-based sales incentives will be asked to explain how and what else they are doing that strengthens this situation. Likewise, we expect banks and other financial services to design their remuneration practices, particularly for the CEOs and senior staff members, to focus on issues other than just short-term bank profitability. So how do we get customer outcomes and some long-term horizon incentive structures going on in the banks? Rob?
So I'll just say a few quick words on the regulatory framework. From a prudential perspective, the review has not identified any notable regulatory gaps for the Reserve Bank, but from a conduct perspective, there are gaps. There is a lack of specific regulatory requirements in relation to conduct across the retail banking sector, for example, where banking products and services are sold without financial advice, such as consumer credit. This has meant an absence of explicit regulatory obligations and related enforcement threat for banks. The report outlines a number of options the government may wish to consider. We acknowledge, of course, that further policy work will be required to fully explore all of those options, and that the government will want to align their consideration of those issues with the existing reviews into the regulation of insurance, consumer credit, and financial advice.
Thanks, Rob. I'll just finish up with a where to from here. And just before I do that, I do want to emphasise this is not a report about gaps. Greetings. About gaps in the regulatory environment of New Zealand. It's about gaps in banks' code and conduct awareness and frameworks and systems. Of course, we took the opportunity to highlight regulatory gaps as available. What we're doing from here, well, specific individual feedback is going to be given to each of the 11 banks that participated. We will be wanting to have a thorough feedback from them by March next year around how they're approaching it, what frameworks, what investments that they are planning and or putting in place. Some are already underway. We also expect all of the banks to seriously review themselves against the findings that are coming out of the Australian Royal Commission. I know that a lot of banks are already undertaking this process, and I would say, if anything, this is the end of the beginning for a lot of banks around understanding what it means around conduct and culture for banks. And we would be expecting them to share those findings with us directly. Any remediation issues that we found, and that any that warrant further investigation, they are being followed up and will be followed up individually with the banks through either the RBNZ, the FMA or the Commerce Commission. So that is activity underway. And we will always hold the option to produce further reports as needed, given the important role that Sunlight has in making sure that these issues are better managed, better looked after through time. The FMA have a timely thematic review underway on bank incentive structures. That's coming out mid-November, 15 November. And we expect banks to implement the changes in incentive programs and suggestions that the FMA are coming out with. Rob mentioned the disappointment about how little interest the banks took on the conduct issue that was put out mid last year. The review of life insurers' conduct and culture is underway, and that will be completed by the end of the year. We will be looking to report on that early in the new year, probably more towards the end of January, and which is a little bit why I said it's the end of the beginning, because an enormous amount of challenges that we have seen in banks certainly also exist across the wider financial product provision, the insurance side. So that is ongoing work which we're right amongst. So I'll just finish up and then we can open for questions, but I want to emphasise that this is a comprehensive and serious review. One of the statistics that was mentioned earlier, it's taken there or thereabouts 14,000 staff hours of investigation. It has confirmed our sense that the state of conduct wasn't tracking in the same direction as Australia, but it has certainly said that we can't explain as much as we would like to, i.e. that there are systems and frameworks and processes that can be put in place that will better ensure that it never tracks in that direction. In this place, it's complacency that is the enemy, and this review should make it very clear to the banks and their stakeholders that they need to take the opportunity now to build a much more sustainable world-class banking system and framework with regard to conduct and culture.